Hey, what's going on, everyone? Welcome back to an amazing week, the Kwak Brothers week here. Welcome to the Real Estate Investing Q&A / the Debt-Free Q&A. Daniel is not here. Actually, he's on a volunteer trip to serve at a church camp. I think we're good to go.
No, they're even saying on the board lost audio. Audio's out. Sam can't hear you. It was good and then it just went out.
Yeah, okay, so
Is it there now?
just want to make sure that the audio is good to go. So while the audio is off, we're gonna wait on making sure that we have the audio.
You'll hear it. I have it.
I hear it right now.
Okay.
But I have it on my phone, so you'll hear it coming through the speakers.
Okay. All right, sir. You are live on YouTube, Facebook. This is Sam.
My name is Sal, and I have a question.
Sure.
If I have a line of credit that is big enough to pay off the entire mortgage,
Okay.
Hello is back.
would that be an advisable step to pay off the entire mortgage and then pay only the HELOC payments?
I'm sorry. Say that again. There was a little bit of background noise there.
So the line of credit that I have on my property is big enough to pay off my mortgage.
Okay, so you have a home equity line of credit that's big enough to pay for your mortgage. Is that what you're saying?
Yeah.
Okay. So what's the question there? Is the question, should I do it or should I not do it?
Yeah, that's the question. Like, should I pay off my mortgage
Okay.
by taking the money out of my HELOC and then make regular payments to my HELOC?
Yep. So seeing that you have our phone number, you're part of our course. Is that right?
Hey Sam, repeat the question.
Yes.
They can't really hear him.
Okay. So if you run through the calculator that you have, you should be able to compare the difference of time and money that you're saving if you do a first position home equity line of credit versus a second position home equity line of credit doing more of the chunk method. So have you gone in and compared the two results to see which one saves you more money and time?
No, I have not done that.
Yeah, so that's what I would do because I wouldn't know I wouldn't know how to answer that question unless the numbers are there, right? I mean, the answer is whichever one that saves you the most amount of time and money. And looking at the context, also, what's going to put you in a safe position in case something goes wrong. So I would first look at how much money and time it's saving you, doing that comparison, and then making my decision from there.
Okay.
Yep.
Got it.
All righty. I hope that answers your question.
Bye-bye.
All right, thanks. All right, wonderful, guys. I hope we got audio. Okay, so Eric is saying we have audio again. Audio is back. I just dropped my phone. So that's good. So you guys can go ahead and go and type in your questions for those who are not part of our program. For those who are part of the program, I even announced it on our secret Facebook page or group of the phone number as well as the time. So for those who are part of the program, our phone line is open. Are you guys hearing the speakerphone okay? I just want to make sure that the speaker phone, the audio from the phone is being heard on YouTube. So let's go and answer some questions. We have Ronan Quinn who says, in Ireland, but what is the best... okay, so Ronan's from Ireland. Awesome. What is the best way to invest in real estate for first rental best way to raise capital to be able to borrow money for apartment. So, Ronan, I'm not sure what the laws and the process and the regulation look like in Ireland, but I do know Ireland is part of the Commonwealth nation, and a lot of the Commonwealth countries have similar law. So, like here in the United States and England, we have similar laws as far as property ownership, banking, finance. And there's a lot of similarities in terms of the law. So I can only answer that question from the angle and the standpoint of the United States laws and regulations and processes. We do have a video on YouTube called How to Buy Your First Rental Property. You may want to check that out. I'll go ahead and leave that link down below after I'm done with it live here. But we do have a separate video that answers that question. But I do want to answer your question directly. One of the first things you can do to raise capital to be able to get into your first real estate deal is first invest in yourself. And what I mean by investing in yourself is get educated, right? Read as much book as possible. Now, Ronan, if you're wanting to invest in Ireland, again, I don't know the whole situation in Ireland, but if you do want to invest here in the United States, what I can tell you is the first thing is you're going to go and invest in yourself. There's 4 currencies that we all need to understand. And I think people are stuck, like a lot of people who want to get into real estate investing are stuck with this idea like, oh, I don't have money, I don't have credit, therefore I can't invest or I can't get into the business of real estate investing, which is completely baloney. There is a way to get into real estate investing without either money or credit. The first thing you need to understand is that there's 4 currencies: money, knowledge, time, and relationships. Okay, I'm gonna go and divide those into a 4 matrix. Now, a lot of people get stuck with the fact that I don't have enough money, right? I'm like, oh man, I'm totally stuck without money, therefore I don't know how to invest in real estate, or I don't know what to do. Now, if you had knowledge, the question is, wouldn't you be able to trade your knowledge in some time for you to be able to make money? Like doctors, right? Doctors, they have special knowledge, right? They know how to perform surgery, they know how to diagnose your illness, they know how to give you the right medicine, prescribe you the right medicine. They have that knowledge, and they're, of course, spending time in the hospital treating different patients. Those 2 combination reflects the compensation that the doctor earns, right? Same thing with real estate investing is if you have the knowledge, the specialized knowledge as far as how to put deals together, how to negotiate for owner financing, how to go raise capital, wouldn't you be able to go and find that money to do your deal, right? Now, the principle of the 4 currencies is that you can trade different currencies in combination for whatever. So I just gave you the example of the doctor who has special knowledge, who's got time, of course, and time's a common denominator. Everyone has time, okay? If you tell me that you don't have time, well, too bad. Everyone's got 24 hours. We all have equal playing field there. Relationship is another big factor as well, right? Because in order for the doctor to have worked in the hospital, he or she would have had to build a relationship with whoever is the administrator of that hospital for the hospital to hire that doctor. So relationship is a mandatory thing. So money is really a byproduct of these 3 things lined up in a specific applicable way, and money shows up. Now, let's think of the reverse. Can we take money and trade it for more knowledge? Absolutely. Right? We can go and take money, buy courses, get into training programs, coaching programs. Same is true with relationships. Can you buy your way into special memberships and clubs? Absolutely. Right? If you have $50,000, you can go buy a $50,000 golf course membership, and you can get in relationships of people that have money. Now, I'm not telling you guys to go do that, right? It's just an example that I've seen people do. But if you feel like, man, I need to raise money, I need to be able to do my first deal, my first go-to is always these 2 things. Okay, I'm gonna put a star. That's a terrible looking star, by the way. So relationship and knowledge are the 2 things that you should focus on and spend most of your time. Trade your time for relationships and knowledge. This will happen when you align these 2 together. Now, money gets created when you put value in front of these 2 things, okay? So the way that my brother and I first got into real estate investing as well as raising capital was we started going out investing in knowledge. We took whatever money we had. In fact, we had a DJ business a while back. I could tell you all about that later. But we sold our DJ business, took that money we had, and bought ourselves an education program and went to different seminars, bought different books. We invested a lot in knowledge. So the first thing we did is we took money, invested in knowledge. And it wasn't a whole lot of money either. It wasn't like millions of dollars, right? It was the little money that we had, invested in knowledge, and we're like, holy smokes, we now know how to go make some more money, right? It's kind of like investing in a fishing lesson. Okay, now we know how to catch fish. We don't have to ever go buy fish anymore. We can just go and figure out how to catch our own fish and feed ourselves. So we went and got knowledge, and then at the same time we were working on our relationship. So we attended networking events. We started going to different places. And I do have a phone call. Let's go and take the phone call and answer some question. All right, you are live on YouTube. This is Sam here. Oh, hold on. There we go. Can you hear me? Hello?
Yes.
Yep, I can hear you.
Hi, Sam.
Hey, how are you?
Good. How you doing?
I am doing phenomenal. So how can I help you and what question can I answer?
I'm in New York, and I see that you have the all-in-one. There's like a $5,000 fee to do that.
Yep.
Is there like a better way? Because like if you're trying to get out of debt,
Sure.
you know, for you to come up with $5,000,
Yep.
you know.
So that's actually the number one objection, I should say, when it comes to the all-in-one loan is the closing fee there's a closing fee. It's a nominal closing fee, and my justification for the closing fee is this. And by the way, I don't make any money off of all-in-one loan. I'm not a banker. I'm not a loan officer. I don't broker loans. All I do is I teach people how to get into these financial strategies and help them out. So there's no incentive for me to tell you go get an all-in-one loan, right? I don't make money off of it. But here's a trade-off, and I know a couple people have paid $3,000, $4,000. I know in this case you're paying $5,000 for the all-in-one loan closing costs. My justification for that is this. When you use a traditional home equity line of credit, just a regular HELOC where there's virtually no closing cost, when you use a home equity line of credit, you have to move the money back and forth from your checking account and then paying your bills, and the process, it could be tedious when compared to doing an all-in-one loan. Now, with an all-in-one loan, whatever money is sitting in your checking account, it automatically sweeps into your home equity line of credit side, so that you don't have to do any of the work, right? You don't have to manually transfer it over. You don't have to open your laptop or your app to go and transfer the money over. Now, whenever you transfer the money back and forth, it's gonna take time. And for us, time can be a very precious resource because there's a limited amount of time. So you sort of have to think of it this way. You're gonna be in this strategy for, it could be anywhere between 3 to up to 12 years or sometimes up to 15 years. All the time that you're gonna spend on doing those manual transfer between home equity line of credit and your checking account, that's a lot of time, right? If you add all the time together, so you'd have to weigh that option. Do I want to spend all that time moving money back and forth on the home equity line of credit, which isn't a lot, but when compared to doing an all-in-one loan where it's more automated, it could save you some time as well. Now, another thing is the all-in-one loan is a 30-year draw, meaning you don't have to go back if you're using a traditional home equity line of credit. Typically, with a traditional home equity line of credit, it's a 10-year draw with a 20-year repayment period. So what that means is if you need your home equity line of credit more than 10 years, you're gonna have to go back to the bank and reapply. And there's always a chance where you can get denied. But of course, if you're using this strategy, you should have almost no chance that you're gonna be denied because you're paying down the principal balance super low or super fast. So if you need your home equity line of credit for more than 10 years, you have to think about this. With the all-in-one loan, you get 30-year draw. To get the similar features as the all-in-one loan, and if you're planning on using a traditional home equity line of credit, that means you would have to reapply for the home equity loan line of credit 2 more times. which means you're gonna have to pay the little to no closing costs with the home equity line of credit 2 more times, and you have to go through that process 2 more times. Now, in that process, you may have to get the home reappraised. You may have to do other fees that might not be that might be applicable. So if you add all that up, when you do a apples to apple comparison, you may actually end up paying close to the same amount with your traditional home equity line of credit versus your all-in-one loan. Does that make sense?
Yes and no, because what it is, I'm looking at a ELOC at a credit union in New York.
Okay.
And their APR is 2.99 for 24 months. It's fixed.
Right.
And there's no closing cost. All I have to pay is $150 for appraisal fee.
Right.
So I'm thinking, if I have my American Express and I put all my bills on my American Express, and then once a month I just transfer the money to pay the American Express.
Yeah.
Then that should work, right?
Yeah, that'll work. And again, the decision has to be up to you. In a technical sense, that's gonna work just fine. The only thing that you'd have to consider is moving that money back and forth again. With the American Express that one time. It's not automated. You do have to do it manually, but it is absolutely a minimal amount of work if you're only having to move that money one time. So yeah, that's gonna work just fine. And again, I'm not forcing the all-in-one loan on anybody. It all comes down to, does it work for you? Is it convenient? Because if it's not convenient, it's very easy for you to drop off the strategy. The key here is it's got to be consistent, it's going to be easy to use, and you got to be on track, and you got to be disciplined. So if that works for you, perfect, phenomenal.
I'm not gonna be in debt for the next 30 years. The whole point of this program is to be out by 10 years.
Absolutely.
You know?
Now the only reason why you're gonna need that 30 years is do you want to get into real estate investing in the future?
Well, that I understand.
Yeah. So it's a flexibility thing.
And that
Yeah.
I'm looking into that, but I want to strategize my personal debt first and then move into that. Yeah.
No, that's perfectly fine. Again, it's all about the goals. It's to someone, a decision may seem stupid or foolish, but if it aligns with their goals and their ultimate goal is, saves them money, gives them more passive income, then great. Now, you may have a different goal where that decision you may not want to make that decision, or you may want to take a different route. So for you, if it works and if it aligns with your goal, what you want to achieve, then perfect. Whatever aligns with your goal at the most safest way to do it, at the same time the most effective way to do it, that's where we want to be at.
Okay.
Yep.
I want to thank you so much.
Yeah.
Because you've changed my mind about a lot of things just reading
Awesome.
your literature, and I mean, eventually I know I'm going to be owning a lot of rental properties. That's my goal.
Yeah.
But it's changed my whole mindset on how I spend money.
Wonderful. I appreciate your kind words, and this is the reason why we do these lives, right? We do these live videos because we want to help people have a paradigm shift with their money, and I appreciate and I love seeing people's lives being impacted. So thank you so much for calling in and asking your question and chiming in for sure.
Thank you.
Yeah.
When I get debt free, Sam, I'm calling you to let you know.
Yep.
It's zero.
Perfect. All right. Sounds like a plan.
Okay.
Awesome. Take care now.
All right. You too. Okay. Bye.
Bye-bye. All right, wonderful. So back to the topic, and I appreciate you calling in all the way from New York. Amazing story, and I love seeing people's lives transform. This is the only reason why we do these lives. I mean, if it's not, I can just go and spend my time elsewhere. But seeing that, we're actually seeing impact in people's mindset, the knowledge, right? That's really important. So back to the topic at hand. When my brother and I first started, we took the money, traded for knowledge, spent some time building relationships, and ultimately, guys, these relationships, they may have currency that you don't have. So my brother and I were always looking for individuals that have currencies that we don't have. We want to build relationships with people that have other specialized knowledge. Right now, we are working with, I don't know if I want to mention the name, but we're working with someone that's an expert in building a software And this individual has a specialized knowledge in building software. So where he comes into play is he comes into our team, helps us build an amazing software, and that's where the relationship currency comes from, right? I could have just gone and traded my time and some money to know what he knows, but why should I do that when I already there's a relationship, there's someone that already has mastered that knowledge, and I can just have that individual work with me. And of course, what that person is getting out of that relationship is, of course, I'm paying the person, and there's the relationship that he also gets access to from my own relationship. So the economy of different currency exchange, you have to understand this. If you don't understand this, it's gonna be very hard for you to make money, okay? Because a lot of times wealthy individuals know that you need to have knowledge, you need to have a relationship, you need to be able to leverage different currencies to be able to make more money. Now, ultimately, the goal is to have lots of this so that you can trade the money for more time. Because time it's limited. Okay, you can make trillions of dollars. Okay, you can make Brazilians of dollars. That's great, but you can't make Brazilians of time. Okay, our days are numbered. We're all gonna turn into dust, and right, we're gonna be dead one day. So we need to invest more into getting our time back. That's why we invest in real estate. That's why we invest in more knowledge and relationships. So ultimately we can make more money and then we can trade our money for more time. A lot of you guys might be doing the opposite, right? A lot of you guys are trading your time for money, okay? Hoping that this is just a result. Because a lot of us see knowledge as just a process. We see a degree, we see a 4-year degree. We're like, oh, we're done with knowledge. We went to college, we got a master's degree or we got a doctor's degree. We're done with the knowledge. Knowledge always, you need to constantly invest in knowledge every single day. Okay, that's why we have books for you guys to read, right? 0 to 75 units in just 1 year. You guys can check that out. By the way, we're giving this book out for absolutely free. Okay, the only thing you have to pay for is shipping, and we'll ship it out to you. Go to 0 to 75units.com. The actual number 0 to 75units.com, and we'll ship one out, a book for free, absolutely for free. We're not going to charge you money for it. You just need to pay for shipping. But guys, learning should never stop. Building relations should never stop, because when these two things stop growing for you, so will this, okay? If you don't invest in your knowledge and your relationship, money will stop. And when money stops, you being able to buy your time back stops. So if you, to sort of answer Ronan, I know we spent a lot of time in this question because this is so fundamental. This is super duper important. If you don't understand this, any other strategy we throw at you, you will not get, and it'll be useless, it'll be futile, and it won't mean anything. So I wanted to cover this because it's a foundation. We don't build houses on sand, we build houses on foundation. So we want to make sure that you guys understand the concept of the foreign currency, because if you don't, you're gonna have a hard time figuring out how to grow and build your business. Okay, let's go ahead and answer some more questions. Joe Giorbolini is asking, what's your opinion on acquiring single-family houses in the Detroit market, since single-family houses are going for $20,000 to $50,000? Okay, so I'm gonna be honest here, guys. I don't know anything about Detroit other than the fact that it is a tough city. There's a lot of challenge. I'll just put it this way: Detroit has a lot of room for growth. Okay, Detroit has a lot of room for improvement, which has its opportunities. Now, I have bought houses that range in that price figure, right? Joe's asking about $20,000 homes to $50,000 home. Now, the challenge with $20,000 to $50,000 homes is that it may be cheap. It's easy to get in, okay? But it's really hard to maintain, okay? So one thing that I figured out is there's a reason why it costs $20,000. There's a reason why the property is worth $50,000. And that is because it's got a lot of deferred maintenance. So you're gonna have to pay for the price, for the real price of the home one way or the other. And what I mean by that is you're gonna get into a home, let's say for $20,000, okay? But in actuality, you're gonna have to spend another $20,000 to $30,000 in the span of the next 2 to 3 years on repairing the doggone thing. Okay, I'll give you an example. I bought a house for $25,000. I spent, let's see, $4,000 on the roof, $2,000 on the porch, couple more $1,000 on just fixing that thing. The heater went out, so I spent another $5,000. So there's a lot of ongoing maintenance and expect for no cash flow for at least 2 to 3 years. Because you're gonna spend a lot of money on fixing it and investing in new capital improvement. So that's how I feel. So even though your acquisition cost may be only $20 to $30, $40, $50,000, expect another $30,000 on the back end, have a lot of cash available or credit available for you to be able to fix it. And once you fix it, repair it, make it nice and improve it, then go ahead and expect some cash flow and positive yield, because it's sort of the price the price has to justify the maintenance, right? So if there's a lot of deferred maintenance, yeah, you're gonna have to pay. You can pay a lower cost, but just expect to pay another $20,000, $30,000 on top of that for maintenance. I hope that answers the question. Joe is asking another question. Any city you recommend us pay attention for with good cash flow and properties that are cheaper? Now, I sort of have a love and hate for that question. Now, I love the question because you're looking and you're figuring out which cities, which market to go with. Now, it's kind of like me giving you the fish versus me teaching you how to fish. Now, when Daniel is back, he's going to teach you how to do some market research. Daniel is really good at researching markets. So rather than trying to figure out, okay, what city is a good place to invest, ask the question, how do I go about the research, right? How do I research these good cities? Let me give you an example. Richmond is an area that we've been investing for quite a while now, Richmond, Virginia. And the reason is Daniel did some research, and Daniel concluded that Richmond has a very strong appreciation, number one, has a lot of migration, positive migration into Richmond, Virginia. And those that are migrating into Richmond, we're seeing wealthier individuals moving in to Richmond area. So that's one of the factors and leading variable as to why we decided to go with Richmond to invest there, to do fix and flips and development projects. We are also investing in another city in Indiana, which we found out that they're putting in a couple $100 million of infrastructure investment, as well as there's a major college there. So instead of trying to figure out, okay, which city is hot right now, like at this given moment, figure out how to do the research, because these cities are going to change all the time. Okay, Chicago, where I live, used to be a hot city to invest in. Okay. Not much anymore. I mean, there's still opportunities for sure, but it's not the hottest, quote unquote. And I sure wouldn't put it on a top 10 list. But these hot cities are going to change all the time. You have to figure out how to do the market research. And this is, remember, going back to the 4 currencies, invest in that knowledge. Invest in how you can go about researching for these economic hot zones where you can invest and have some positive yields. Okay. Fernando's asking, what if the best form to create LLC structure to accomplish inside and outside protection and I can't say this word, anonymity for the purpose of real estate buy and hold rentals? So I'm guessing Fernando is asking, what is the best way? The best way for you guys to go and create an LLC is to consult with an attorney, guys. I'm not gonna give any legal advice here. But go in and invest that time with an attorney. I know it's gonna cost money. Yes, you're gonna have to spend a couple $100, but guys, that couple $100 is an investment. You're paying it forward for your own protection. Okay? If you get into a lawsuit, it's not gonna cost you a couple $100. It's gonna cost you thousands of dollars, perhaps even millions. I've talked to an individual who's got a $1 million judgment. Guys, not a very good, bright situation. Okay, this individual has to have their wage garnished, all because they didn't talk to an attorney before they engaged in a deal. Okay, just a couple $100, and I don't get paid to tell you that, right? So guys, go talk to an attorney who's licensed, who's competent, and who practices law within the real estate realm. So make sure you have a conversation with an asset protection attorney. Figure out which entity is right for you. You may not need an LLC. You may need a living trust. Maybe you need some more deeper estate planning. Maybe you need an LLP, a limited liability partnership. Who knows? So have a conversation with an attorney to figure out which entity is the right fit for you based on your situation, your goals. Okay? Justin Hodge is asking, can I take over a short sale property subject to and live in it? It's a tough one because a lot of the banks want to see that you pay it off it's got to be done on a cash sale. Now, I think what you might be asking is, can I reinstate the loan and do a subject to? And in that question, yes, you can do it. And actually, that's more the preferred way to do it, mainly because you want to be able to capture all the equity that was left in place by the previous owner. So let's say the previous owner, something happened, they stopped paying their mortgage, they're behind 5 to 6 months. Some banks and lending institutions may give you an opportunity to reinstate the loan before it actually goes into a foreclosure or a legal process for your for a foreclosure action. I know that there's a difference between a deed of trust state and a mortgage state. So you can reinstate the loan. The banks will tell you how much you need to pay to reinstate the loan. Sometimes it could be $5,000, $10,000, whatever the amount may be. So as an investor, you can come in and say, hey, Mr. or Mrs. Seller or homeowner, I can see that you're 6 months behind. What if I give you that amount, whatever amount that may be, 6 months behind, and I'll give you another $2,000 for you to leave, and this will help you save yourself from a possible foreclosure. This is not gonna hurt your credit. We're gonna reinstate the loan, and I'm gonna go ahead and make that mortgage payment on your behalf. The only difference is I'm gonna go ahead and take over the property. You're gonna be moving to another place, and this is gonna be my property. Okay, so let me actually draw this out on the board so you guys understand what's going on here. So here's a property, okay? And attached to the property is the owner, right? And here comes you, and of course this home has a loan, okay? So what's gonna happen is that since the owner is behind on their monthly payments for 6 months, you're gonna go and approach the owner and say, hey, I'm gonna give you the 6 months of loan payment so that you can pay the loan. I'm also gonna give you something extra, okay, whether it's $2,000, $3,000, for you to be able to move and live elsewhere, whether you rent into a new place or you move with the family. Whatever you do with the money, it's up to you. So you give them extra money for them to move out. So once they move out, they're no longer attached to the property. They're gonna deed the property to you so that you have ownership of the property. Now, moving forward, since the loan is reinstated, it's in good condition, it's up to date, you're gonna go ahead and make the monthly periodic payments to the loan, but the borrower's name is still under the owner's name. Okay, but the property ownership is deeded to you, so you technically own the property, but you're making loan payments to the original loan that was between the previous owner and the lending institution. Now, what I hope to get out of that is, number one, the goal is to capture any equity that was built, okay, because the owner has been paying the loan payments over time. That's what I hope to accomplish. And number two is I don't have to use my own credit for this transaction, right? Because I got to use the previous owner's credit. I'm just taking over their loan payments. That way I didn't have to go through the banks and get a separate loan or a separate financing arrangement, which would have involved my own credit. It would have to go through an underwriting process and so on. So that's what I hope to achieve in that arrangement of a subject to. In a traditional short sale, the banks and the lender typically wants you to do cash. There's a rare situation where they may let you do a short sale on an installment payment. I haven't seen that, but more than likely in a traditional short sale, you're gonna have to do cash. Okay, you're gonna have to do all cash. All right, let's go ahead and answer any question. JMF is saying, what would be the best way to market a property to sell with seller financing contract for deed? So if you are the owner and you're selling the property on a owner financing or contract for deed, it actually shouldn't be that hard. It actually kind of like putting raw meat out in a hot summer day, and the flies just come and swarm and attack the meat. And of course, the flies being the investors and buyers. But selling things on owner financing is rather easy. Screening for the right buyer is where you have to be extra careful. And when you screen for the buyers, make sure you have a couple of things. Number one, you want to have pull their credit. Just do it. Trust me, it's going to save you a lot of headaches down the road. So get a credit report, and it doesn't have to be a hard inquiry. It could be a soft. I prefer doing a hard inquiry. So get a soft inquiry credit report on the buyer. Okay, it's a very similar process that you would do as a bank would. Take a look at their credit report to see if there's any delinquencies, any late payments, any foreclosures, bankruptcy in the past. Make sure that they have solid credit, and don't just look at the credit score. Look at the whole report. See where they have been late. See where they have any problems. Number two is I want to see bank statements. Preferably, I want to see tax returns. Okay. Now, this is all risk management. I want to mitigate risk. I don't want to just take on buyers and 2 months or 3 months down the road, they stop making you payments. That's not what I want. I want buyers that can afford this, and if they're self-employed, I want the bank statement. And I want to see how much cash they got. Okay? If they have a W-2 job, I want to see a tax return. And number three, what I want to see is I want to do some interview. I want to see their experience. Okay, if they are an investor, if they are just a homeowner looking to buy a home, obviously that's not going to count. But I want to see their tax return, bank statement, credit report, and I want to see if they have any other debt. Okay, I'm going to do a debt to income ratio and figure out, can they afford the monthly payments if I choose to sell the property on owner financing. If you don't do this, you're behind the 8 ball. Okay, you're throwing a dice here and hoping that you're gonna get a good buyer. So what I do is I screen my buyers, check their credit report, check their bank statements, their tax return. If they are an investor, I want to see their experience. I want to see how they screen their tenants and see how many units they have. I want to see how much debt and assets they carry. I want to see all that. I want to be able to mitigate my risk, because if I sell this property on a seller financing and they stop paying after 2-3 months, woes to me, right? I don't want to be on that uphill battle trying to get the property back because they're not paying. Okay, so that's what I recommend, and that's speaking from my own experience. I have sold properties on owner financing, and I've seen the bad, I've seen the good. So just give you guys that recommendation. Let's see here. Ronan is asking, you should never buy unless all you own is under a different name. They can't come after your own home for lawsuit reasons. Makes sense in Ireland. Is same lawsuit culture here. Yeah, so that's why you want to have a conversation with an attorney to make sure that you have the right entity set up, right legal protection, make sure you have the right contracts and languages in the contract, of course. You want to have all those things, not just for fancy, oh, look at me, I have a business. Okay, it's not for that reason. It's to give you guys an actual protection and give you guys that upper edge, so to speak, to make sure that you don't get sued and you don't lose everything. Okay, at the end of the day, it's not about how much money you make. Sure, that's important, but it's also about how much you keep. Okay, it's no good when your back has a hole and you're trying to carry coins through it. It's not gonna help you guys. So make sure you got your it's CYA, right? Cover your assets. I'm not gonna use the actual terminology. Cover your assets. Okay. All right. Justin Hodges is following up and saying there's another aspect to it. It has an adjacent lot next to it so that I can build on, but paying a high tax rate on it. Write it in Streamwood by us. How can I get the taxes lowered for the land? That's an interesting question, because now you have different moving parts. And here's my philosophy in pretty much any real estate deal. When you're either a beginner or you don't have a whole lot of experience, don't do a deal that's got a lot of moving parts. Okay, and what I mean by moving parts is if you have to do this, and then this, and then this, and then this to be profitable, yeah, that's a whole lot of unnecessary moving parts. Try to stick with just 1 or 2 moving parts, meaning you're gonna buy it, rehab it, and then rent it. Okay, you really have 3 moving parts there. Traditionally, you wanna just have 1 moving part is buy it and hold it. Okay, the more moving parts you have, yes, there could be more opportunities for you to be able to make money, but there's even more opportunities where you're gonna mess up and things can go wrong. Because each moving part represents a work and labor you gotta put into, and skill set and knowledge that you have to put into. So anytime there's a moving part in a deal, and the more moving parts you add into the deal, the riskier it becomes. So right now, having this land deal added into this property sounds like a lot more moving parts than it is necessary, because if you want to do something with the extra land that comes with, it predicates a lot on zoning, right? You got to do zoning, you got to get permits, you got to go through a lot of red tape. Now the question is, what if those red tapes don't go through? Do you have, a backup plan? Do you have other skill sets and knowledge for you to leverage to be able to turn that into a profitable deal? So this is why I'm saying less moving parts, the better. Keep it simple, right? Especially when you're just getting started, keep it simple, because the more moving parts, riskier, more problems you're gonna see, more time it's gonna take for you to be profitable. Okay, let's see, we got T-Tama is saying, hi Sam, is cash flow more important versus getting a property with close to zero cash flow, which is more favorable in terms of location and appreciation, but is more EXP? I'm not sure what that EXP stands for. I'm not sure if it means experience, but I say it's both. Or I should say, here's my real answer to that, and Daniel can probably answer better than I can. But here's my answer, and I'll give you just my angle to it. Is it depends on your goals. Okay, it really does. If you are a high fluent individual, you got $25 million of asset, maybe your concern isn't to make more money. Maybe your concern isn't to add on to your wealth, but maybe your concern is to mitigate your tax losses. So real estate has a way for you to mitigate some of the tax losses, of course, through depreciation, as well as some of the other things you can do. So it depends on your goals, okay? If you are a high fluent, wealthy individual, cash flow may not be an issue. Maybe you don't need more cash flow. Maybe you need a loss on your portfolio so that you can mitigate some of those tax liabilities. But maybe you're the opposite. Maybe you need cash flow. You need to build up as much cash flow as possible. Then yeah, you may want to look and make that decision with a lens of, okay, I need more cash flow. Which deal will get me more cash flow and also give me more appreciation? So ideally, you want both, right? You don't want to just get cash flow and have zero appreciation and zero equity. Okay, this is the problem that I have with people that take on a bunch of cash flow, but they have like zero ownership and zero equity that they're building. You gotta have both, because it gives you protection for and more control over the long run. Some people are just strictly appreciation equity. The problem with that is, of course, with appreciation equity play, it's a long-term game. So you're gonna have to wait a while for cash flow to actually show up. So ideally, you want both. You want to have both cash flow, equity, and appreciation, all the above. But again, going back to the foundational question of that and the philosophy of this is, what is your goal? Okay, what are you lacking? What do you have that you need to supplement or complement? So that's sort of the question that you need to address before I can give you a more of a concrete answer for that question. J Local Arts is asking, so I was told to buy a house under myself as a name, then transfer the house to my business name. Can you explain why? One of the main reasons I can see for that particular predicament is for financing reasons. Most banks won't, and I shouldn't say won't, they'll discourage you, or they'll discourage themselves really from lending to an LLC or a business name. They prefer to lend to the actual person and the person's name rather than an LLC or a corporation, because they want to make sure that the loan is getting paid. And for the loan to get paid, they want to ensure that your personal liability is on hand. They want your skin in the game, so to speak. So that might be the reason why someone has told you to put the house under your name so you can get financing or refinancing and then transfer it over to a business name. That might be the reason why. Typically, I just prefer to put it on a business name because it affords me protection. Again, have a conversation with an attorney to make sure that whatever route that you take, it gives you protection and also safety nets. You want to make sure that happens. Okay. JMF is asking, do you know if having a VA loan would complicate selling with seller financing? It could. I'm a veteran myself, so I know I've done a little research on the VA loan. When you sell the property under VA loan, they prefer that there's no, you can't assign a VA loan, meaning you can't have someone else go ahead and take over the loan and, make it theirs. Usually VA loans won't let you do that because if they're not the veterans, right? It would be better that you sell on a more of a cash transaction or just selling it as cash. You can, however, do a sort of a wraparound contract for deed situation where I'm gonna go ahead and switch over to the board. Okay, here's you, the seller, and here you have a VA loan that you're making monthly payments. Let's say, I'm gonna use red because I feel like red, you can see it better. Let's say your monthly payment for the VA loan is, I'm just gonna make it dead even $1,000 a month. Here comes another buyer where you may establish something called contract for deed, okay, or formerly known as installment. Sorry, I'm like buffering here. Installment agreement for the deed. Man, it should be agreement for the installment of the deed. Yeah, there's a lot of different names for it, so it can get confusing. So there might be a contract for deed or an installment loan between you and the buyer, and that payment amount could be, let's say, $1,200 a month. So the buyer didn't take over the VA loan necessarily directly, but there's another loan that establishes on the front end. They're paying you $1,200 a month, and you are paying the VA loan $1,000 a month. So in this case, there's a little bit of arbitrage here of making $200 a month being in the middle, okay? So that's a way to do it. This is sort of like a wraparound. We don't call it a wraparound, but this is sort of a wraparound contract for deed thing you could do between you and the buyer, and then, of course, making sure that you make that payment to the VA loan. What I prefer to do is I prefer the buyer to pay for the taxes and insurance, of course. A lot of times your VA loan is going to require you to escrow that, so you may have to build into that payment so that the buyer is essentially escrowing the taxes and insurance over to you, which you're going to go and pay the VA loan for them to escrow and pay the city and insurance and so forth. So that's one way you can do it. Sort of a front end wraparound contract for deed combo, right? It's a very creative way to do it. Again, there's nothing wrong selling a property with owner financing. You just got to do a really good job vetting the people. Okay, hope that answers that question. Soul Joy Live is asking, I paid for a home cash under my LLC. How can I use money / equity from paid home to purchase a new home? So what you can do a cash out refinance or a cash out home equity line of credit or just a standard equity line of credit. There is a such thing. It's rare, but there's a product out there that does that. Now, I sort of have two schools of thoughts for that answer. Yes, you can go ahead and expand, do a cash out refinance, take the money and buy a rental. Now, my second school of thought for that is it's a timing and economic issue. Because right now, things are really hot. And what I mean by things are really hot is market's doing really, really well. Economy is doing really, really well. And a lot of the property in terms of value has appreciated. Now, I've been saying this a lot lately, especially in our live videos and some of our live calls that we do, is the appreciation that we built is a phantom appreciation, meaning the appreciation is actually not real. The appreciation that we built, the home value, the increase of home value can easily fall and drop as soon as a recession begins. Now, Daniel and I have been saying this for over a year or a year and a half now, that we believe there's a recession coming in the next year or two, 2020, 2021. We believe that there's gonna be a recession coming out. Now, when you do a cash out refinance, and let's say you refinanced at 80% loan to value, which if you're gonna do a cash out refinance, I prefer you not to do 80%, maybe do 50 or 40. But if you choose to do a 80% cash out refinance, and let's say next year the recession happens and your home value falls by 30%, well, now you're underwater, meaning your home value is worth less than what you owe on that cash out refinance loan. Now now you're running into a problem where the bank might call you and say, hey, Mr. and Mrs. Borrower, your home value has dropped way below what you actually owe. We're gonna ask you to go ahead and pay the difference, whether it's, however however that amount is, we're going to ask you to pay for that amount right away, or we're going to go and deem this property in default, and we're going to foreclose on you, which is not what we want, right? We don't want your property, for being foreclosed. We don't want that situation. So there's a school of thoughts on that. Is yes, you can go and cash out refinance to go and buy other properties. You can do that for sure, but it comes down to timing. Okay, I believe the better timing for you to do that is after the recession happens. Once the value drops, okay, and we're at a low point, then I believe it's safe to go and expand, get a little aggressive in terms of what you borrow, how you borrow, and what you buy, and so on. So it comes down to the timing of everything. It's not the strategy alone that makes you money, guys. It's the timing and the environment and the context of how you're using that strategy that ultimately leads to profit. Okay. All right. So let's see what time it is right now. We are at 11:53 Central Time. So we'll take on one or two more questions. If you guys are a part of our program and our course, of course, you guys have the phone number to call, to dial in and ask your questions live right here with me through the phone call. If you guys are not part of our program, or if you guys are not part of our course, you guys can always ask your questions through the live chat box and type it away. But yeah, this has been good, guys. Phenomenal episode. I'll be back here Wednesday to answer additional questions about paying off your debt and paying off your mortgage and so on. So any other questions you guys can go and ask. Now, if you guys are watching this after we're done with live, you guys can continue to ask questions, or you guys can go and tune back again next Monday or this upcoming Wednesday to ask any questions that you may have. We're gonna be doing this as long as we can to answer your questions, guys, and to really build this relationship. I know most of you guys are in camera land and we have never met in person, but we'll love to build that relationship even through just having a chat through the chat box, or if you guys are a part of our program, you guys can call in to ask those questions. So we'll take one more question before we wrap up this episode, this live that we were doing. I don't think I have any other questions that we see on the live chat box. So, okay, we have one more question from Jay, Local Arts. You may have covered this. However, I believe Robert Kiyosaki once said, you sell real estate, you should buy more expensive real estate to avoid taxes. Yes, it's true, but it's kind of like saying you should always, and I'm trying to give you a good example of what Robert's really trying to say, because the context matters a lot, more so than the content. It's kind of like saying, don't ever drive your car. Okay? Well, what does that say? Well, don't ever drive, right? But the context is right now outside it's hailing, it's snowing like 20 feet. It looks like Hoth from Star Wars. Okay, I'm a Star Wars fan. So it looks like Hoth outside, and there's a nuclear war happening. North Korea is invading right now. Yeah, maybe that statement is relevant at that point. You shouldn't be driving outside because it's really, really dangerous. So what Robert is saying is, you should always be expanding your territory. You should always try to figure out how to take your single family and buy a 4-unit, take that 4-unit, buy a 16-unit, take that 16-unit, buy a 36-unit. You should always be expanding, but remember, timing is what makes you wise, okay? It's the context that matters more than what you actually do. I see a lot of people right now buying over-leveraged properties, overpriced properties. I wish them sincere luck, I really do. I don't know how they're gonna weather through recession. I see a lot of people selling their properties right now because they're starting to see that sign. They're starting to see that recession, and I think they're a little too late. So it's the context, guys. Context. Super duper important, okay? You can hear an advice from somebody. The advice sounds so wise and so good, but without the context, the advice means nothing. It's kaput, okay? T. Tama is asking, is it better to get a HELOC now using a higher appraised value of our property? Yes and no, as long as you're not leveraging yourself through the wazoo, meaning you're not using 100% of the HELOC, I think you're gonna be okay. Again, it's, I keep saying this word, context, right? Super important. So yes, you can get a HELOC, just don't go crazy and use like 80% of it or 100% of it, My safe answer is almost always use 30% or less of your HELOC to invest in appreciating income, I should say income producing asset that's also appreciating. So, guys, the theme of this episode is context. Okay, it's kind of like Sesame Street. The word of the episode is context. Okay, so be sure you guys keep that in mind. You guys can hear all sorts of strategies, all sorts of advice, all sorts of different great things that are out there in the world. But if you are missing the context, the timing, and the environment to which the advice can be applicable, the advice is actually going to hurt you more than it can help you. Okay, even from our own videos, guys, if we tell you to do a strategy or we suggest that you do a strategy or we give you an advice, make sure you do the research on the context of everything that we talk about, even in our own YouTube channel, because we don't want you to fall into a deadly pit where you can get stuck financially. So it's super important that you guys understand that, because I don't want you guys to put it, I don't want you guys to be in a challenging situation. So it is, let's see, 11:58 Central Time. Guys, thank you so much for watching this live episode. We're gonna be back on Wednesday at 11 o'clock Central Time to take more questions, answer your questions, guys, and we'll be back on Wednesday as well as next Monday at 11 o'clock. I'll see you guys in the next video. Take care. Have a blessed day. I'll see you guys next week.